Boom. All right, so I felt a little guilty about going into liquidity ratios without actually talking about what liquidity ratios are about. So we are going to start going into our long-term solvency ratios, and I did not want to carry that same guilt with me. So I decided to knock two birds out with one video and talk about both of them. So liquidity ratios, as you've probably noticed, have a lot to do with current liabilities. So our cash ratio, we were trying to see how efficient or how well, same thing really, how likely, I should say, how likely, that's better, how likely are we to be able to take care of our current liabilities? Okay, so in our cash ratio, we just wanted to see how much cash do you have, and are you able to take care of your current liabilities with that cash. Obviously, it's not going to be a deal breaker because there are other ways of you taking care of your current liabilities, which is just money that you owe within the year. Okay, and then we had other examples. We said there were current ratios that we could look at. We looked at net working capital. I don't think I mentioned this yet, but we also looked at quick ratio. So these are certain liquidity ratios that we can look at to see, is this company going to be able to satisfy its immediate obligations, the money it owes within the year. But that's not going to be the end all be all. A lot of times when we borrow money, it's going to be for more than a year. So we have our long-term solvency ratios, and this just looks at total debt. Now you're going to start seeing total debt being looked at. You're going to see long-term debt being looked at. So long-term solvency ratios. A lot of times we just call them our solvency ratios. And for you to remember the difference, you can just think liquidity, obviously, how quick do you turn whatever you're looking at into cash. That's what liquidity is. And why would we be worried about turning things into cash really quickly? Well, we have some bills that are due. We have some things that we need to pay off within the year. So if liquidity comes into play, you probably have some money that you owe that needs to be paid off immediately. Solvency, I remembered myself because of the word solve. How do we solve our problems that may come up in the future? So it does. I mean, why do I choose that way? For some reason, it just makes sense to me. All right, if I think we have a problem, it's probably a big deal, or it's probably something very complex and heavy. And I see my long-term obligations as complex and heavy things. I see them as something way more serious. I actually have to sit down and ponder, what can we do about this? So in my mind, I see a problem. I think, okay, something serious is happening. I need to solve this problem. So I know that I'm looking at long-term liabilities. However you remember it, fine. I know my way of remembering it doesn't really make much sense, but it just makes sense in my head. You just have to know that liquidity has to do with turning things into cash. And the more liquid something is, the more easily it is for us to turn whatever it is that we're talking about into cash. And liquidity ratios have to do with paying our short-term bills, our current liabilities, things that are due within the year, and our long-term solvency ratios look at our ability to take care of our overall debt, our big problems, the debt that's going to be waiting for us even after this year is over. Okay, however you want to remember the difference between the two is fine, but just absolutely know that solvency ratios, you're going to be looking at a lot of total debt. You're going to be looking at long-term debt. Okay, so that's it, guys. Hopefully I don't carry that same guilt with me since we went over the difference between the two now.